Hey, we're back from KORONA POS. For most small businesses, it's necessary to find ways of funding your business's operation, whether it's startup cost, expansion, or renovation. Very few small business owners have the capital on hand from the get-go. And we've talked plenty in other videos about how to secure loans, grants, or other financial assistance, both from traditional and non-traditional lenders. But one that we haven't talked about exclusively are merchant cash advances, or MCAs. These are another way that businesses can raise quick capital to keep themselves afloat. So what is a merchant cash advance? How are they different from traditional loans, and what are the pros and cons? Let's dive into the topic so your business can make the best decision for your future. First, what exactly is an MCA? It's important to clarify at the beginning that it is not a loan. It's a relative newcomer to the realm of financing. Merchant cash advances actually originated just in the 1990s. And though similar to a loan, there is a key difference. A loan is paid back in installments over a set period of time. Instead, an MCA is money given to the business but leveraged against future sales. The lender will therefore receive the money by obtaining a percentage of future sales from the business. The funds are not owed until the merchant actually makes a sale. Let's go a little more in depth into how they actually work. Traditionally, MCAs are for businesses that primarily accept payment from credit and debit card sales. Businesses can set up an MCA agreement in two ways. They can receive the cash up front that will be repaid through a set percentage of future credit and debit sales, or receive cash up front that will be repaid through a fixed amount on a set time schedule from your bank account. This latter one is referred to as an automatic clearinghouse, or ACH, and is more similar to a traditional loan. The repayment structure is determined by the lender beforehand. Lenders will determine the risk factor using a factor rate. A risk factor is typically between 1.2 and 1.5. The lower the factor rate, the higher the fees will be. So what are the exact differences in repayment structures? Ostensibly, the ACH repayment structure was implemented to help businesses that do more cash transactions qualify for an MCA. But let's break it down in more detail how businesses can repay these advances. Let's say that a merchant was given a risk factor of 1.3 for a cash advance of $100,000. Based on that risk factor, we'll say the fees will be $40,000 for a total repayment of $140,000. With the percent of credit and debit card sales, the lender will automatically deduct a percentage until the $140,000 is completely repaid. The time frame for repayment will be estimated by the lender, but it ultimately depends on the total credit and debit sales made by the business. In the end, the more sales your business makes, the faster the loan will be repaid. If your cash advance provider agrees to take 5% of all credit and debit sales and you make $500,000 the first month, they take 25 grand. But if you only make $250,000 the following month, they'll only take $12,500. Again, the final amount will depend on your sales, allowing you some flexibility in slower months. Fixed withdrawals leave you with less flexibility. Under the same scenario, you'd be given a set amount to be repaid based on your average sales, but the final amount paid will always be the same instead of fluctuating from month to month. So now that we've covered how MCAs work, let's take a look at traditional lending. When a business owner is in need of funding, they might look for bank loans. More favorable loans, long-term loans with low interest rates, are harder to come by. Borrowers must have a great credit history and years of operation. Newer businesses usually apply for short-term loans for capital that needs to be used quickly. These loans are for smaller amounts and must be repaid quickly. And both may also require collateral to be secured. A line of credit with a bank is also similar to a short-term loan. These provide immediate capital assistance to businesses whenever they need it. Like either of these loans, interest must be paid on any line of credit used until it's repaid in full. So let's go over the pros and cons of merchant cash advances, and we'll start with the pros. While they're risky, there are still some upsides to going the route of an MCA. Pro number one, it's easy to get. If your business needs immediate financing, an MCA may be the way to go. Traditional loans can take weeks to process, far too long for some urgent situations. Cash advances may only take 48 hours to reach your account. This is because of the high interest rates. They're eager to get business to use them. Pro number two, you don't need great credit. It can be remarkably difficult for new merchants to qualify for a traditional loan. Too often, it's a catch-22 of trying to qualify by showing you have a viable business without having the years of experience necessary to prove it. The old mantra of needing to spend money to make it is thrown out the window if you can't get any money from the beginning. Instead, cash advances are available for those who don't necessarily qualify for a traditional loan. Pro number three, MCAs never require traditional collateral. Instead, the collateral is in the form of future sales. The provider will only look at your current sales to determine how much you qualify for and the terms of repayment. While there is a time and place for this form of borrowing, it should never be your first option. There are some serious cons to the process, so let's go over those. Con number one, there's not a lot of flexibility. MCA providers will not work with you once the terms are agreed upon, and your interest will be really high. Con number two, yes, interest will be high. So will the fees. Because it's a riskier loan to offer, there's no collateral, credit history, years in operation required, so on, the provider is going to charge a pretty penny in fees. In fact, your annual percentage rate, or APR, might even be in the triple digits, and it will likely be at least 50%. You'll certainly find hidden fees too, so be prepared to get nickel and dimed throughout. Con number 3, there's no ability to pay it off faster to save money. If your plan is more aggressively repaid, the APR will be higher, and there are certainly no refinancing options in your favor. Con number 4, it hurts cash flow. Obviously, a percentage of your sales each week or month going back to the provider will hurt your cash flow and growth over the course of the loan. And con number 5, it's just kind of shady. These lenders have a reputation for a reason. Because lending is determined to be commercial transactions rather than loans, the industry is not regulated, and it's hard to separate the fair providers from the real sharks. So, should you do it? It's usually a hard decision. While there may be some extreme circumstance that warrant an MCA, it should be a final resort for any business. The downsides are simply too dramatic and risk putting you out of business. Do your research first and look for friendlier alternatives before making the dive. For more business advice, check out the rest of our blog and subscribe to our channel. And for info on your operational structure and how it can help your business grow, click the link in the description to learn more about Korona POS. You'll find no fees or surcharges with us. Thanks for watching today.